Welcome to the Riskwiser Zone, the podcast where we dive into the latest developments in the world of finance and technology. I'm your host, Louis, and we're excited to have you join us today. We're starting off with a fascinating story that's been making waves in the tech industry. Saudi Arabia's public investment fund has launched a new entity called Humain, which is set to become a major player in the world of artificial intelligence. According to reports, Humain has signed deals with top U.S. tech firms like NVIDIA, AMD, and Qualcomm, worth tens of billions of dollars. These partnerships will enable Humain to build massive data centers in Saudi Arabia, utilizing cutting-edge technology to support the development of AI systems. The project is seen as a strategic move by the Saudi government to diversify its economy and reduce its dependence on oil exports. Now, some of you might be wondering why this story matters. Well, the implications are significant. With Humain's data centers, Saudi Arabia is poised to become a major hub for AI research and development, attracting top talent and investment from around the world. This could potentially create new opportunities for businesses and investors, while also raising important questions about data security and privacy. We'll be keeping a close eye on this story as it unfolds, and we'll be exploring the potential risks and rewards in more detail. But for now, let's just say that Humain's ambitious plans are definitely worth watching. It's also worth noting that this development comes at a time when the global tech landscape is evolving rapidly. With the rise of AI, cloud computing, and other emerging technologies, we're seeing new players enter the scene, and traditional powerhouses adapting to stay ahead of the curve. As investors and risk managers, it's essential to stay informed about these trends and their potential impact on our portfolios and businesses. That's why we'll be discussing this story and many others like it on the Riskwiser Zone. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're glad you're still with us as we navigate the twists and turns of the business world. Today, we've got a fascinating story about leadership changes in the automotive industry. You might have heard that Stellantis, the parent company of iconic brands like Jeep, Fiat, and Peugeot, has appointed a new CEO. His name is Antonio Filosa, and he's been with the company for over 2 decades. Now, let's take a closer look at Filosa's background and what his appointment might mean for Stellantis. Born in Naples, Italy, Filosa graduated in engineering from Milan's Polytechnic and joined Fiat Group as a trainee back in 1999. He worked his way up the ranks, taking on various roles in Latin America, where he eventually became the chief of Fiat Chrysler's operations in the region. What's interesting about Filosa is that he's been tasked with reviving sales at Stellantis' North American operations, which have been struggling lately. As the new CEO, he'll face significant challenges, including stiff competition from Chinese automakers and the need to transition the company's portfolio to electric powertrain. Analysts are watching closely to see how Filosa will tackle these challenges, particularly given that Stellantis has a complex brand structure with 14 different brands under its umbrella. Some of these brands, like Maserati and Chrysler, have been underperforming, so it'll be interesting to see if Filosa can turn them around. Now, we know what you're thinking. What does this mean for investors? Well, the market's reaction has been mixed so far. Some analysts are optimistic about Filosa's leadership, citing his deep understanding of the company and its people. Others are more cautious, pointing out that Stellantis still faces significant headwinds in the industry. As always, we want to encourage our listeners to do their own research and stay informed about the latest developments in the business world. It's essential to consider multiple perspectives and weigh the pros and cons before making any investment decisions. That's all for now on this story. We'll be keeping a close eye on how Filosa navigates the challenges ahead and what it means for Stellantis' future. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone, folks. I'm your host, Louis, and we're wrapping up another informative episode of our podcast. As we've been discussing throughout the show, the world of finance is always full of twists and turns, and today's topic is no exception. We've been exploring the impact of U.S. tariffs on the global economy, and specifically, how they're affecting India's stock market. Now, I know some of you might be thinking, Lewis, this all sounds like a bit of a mess. And you're right. It is complex, but that's why we're here to break it down for you. According to recent reports, Donald Trump's tariff policy has been the biggest driver of the market since April. After an initial tumble, the market saw a relief rally when the U.S. paused tariffs for 90 days and initiated negotiations with China. This rebound helped the Nifty cross the 25,000 level for the first time in 7 months, and foreigners are on track to make their highest monthly purchases in May. However, as we always say on this show, don't get too comfortable. Long-term foreign money is still far from bullish on India, citing rich share valuations and slower economic growth. In fact, global fund managers like Ajay Rajadaksha of Barclays and Christy Tan of Franklin Templeton Institute have expressed caution about the Indian equity markets. So, what's driving this cautious approach? Well, it's largely due to uncertainty over the effect of U.S. tariffs on the global economy. Seasoned money managers are taking a wait-and-see approach, preferring to gauge the impact of delayed fresh investments and dampening CEO confidence. And with Trump's pause on tariffs set to end on July 9th, there's still a lot of risk perception in the air. Now, I know some of our listeners might be thinking, but Lewis, what about the recent influx of foreign investment? My friends, that's just it. It's hot money buying the dip and selling the rip. It's not a sustainable trend, and we should be cautious not to confuse it with a genuine bull market. As we always say on this show, safety first. And it seems like global investors are starting to agree. There's a shift towards fixed income, with bonds becoming more attractive as investors reassess risk. In India, this is playing out through a pivot toward hybrid products, with domestic fund managers pushing multi-asset allocation funds and arbitrage-based hybrids over pure equity schemes. So, what's the takeaway from all this? Well, my friends, it's simple. Invest with caution. Don't get caught up in the hype of short-term gains. Take a step back, assess the risks, and make informed decisions about your investments. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, invest with caution. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, keep your finances in check.